if you make an offer to buy a house, you're wise to set forth a period of time with which you have to have it inspected, right? And address any deficiencies that come up before you're obligated to go through with the purchase. Well, due diligence is a title for a step in a process of purchasing a high-value, complex asset. And your company's pitch deck is like a listing sheet for a house. It's just a summary. No one should buy a house based just on the sheet. And no one should give you money for your company based only on the pitch deck. And that's because the more examined your company is, the higher the returns. And you can see that in the data here. When we do very little diligence, less than 20 human hours, the average returns in angel investing are barely getting our money back. But when we double that to more than 40 hours of investigation, the returns skyrocket. And there's a benefit to you in that. And we're going to understand that here. But I want you to hold this thought. The more we examine you, the higher the returns. I'm not going to pretend that there aren't investors in early stage capital who skip diligence and can afford to. The Vegas endorphin rush without the travel hassles. But it unfortunately seduces many of you as startups into treating fundraising like a sport of personality and persuasion. Let's be honest. It's more fun for all of us to talk about your exciting ideas and imagine wild success than to do the drudgery of quantified business planning. It just is. And there are two types of pea pods of early stage investors. There's the professional investors and the gamblers. And there's a similar set of two peas among founders. There's the founders that really aren't that sure they can pull off what they're pitching, but they're happy to make a living convincing others of it and living off of that as long as they can. But better founders are convinced the world needs what they've got to offer and they will pull it off. Extra credit at the end of the day if somebody can tell me what a Momo is. So as with any marriage, compatibility is critical. I choose to speak to professional founders who should not want gamblers for investors because they're just money. They usually don't help you further than that. They don't want that job. They're just rolling the dice. If you're serious about growing an infant business into a mature one, then you need professional financial partners who can help you with their experience, and their connections and know-how, and not just their money. Now, if the owners of the house have prepared every square foot before listing it, then the buyer's inspection merely confirms its excellent condition and you can complete the sale. In your context, that means that for you founders, if you have already rigorously constructed a bottom-up, birth-to-exit business plan by the numbers, then you're probably going to have a fairly easy time raising capital. But often, owners imagine their house is good enough to sell. They spent all their money on their garage projects and didn't focus on the rest of the property. So they throw it on the market as is, trying to get shoppers to buy its potential and ignore its actual condition. They haven't really uncovered and examined a lot of the execution risks. And the same goes in businesses. So we focus our pitches on how cool our ideas are and what a world filled with them looks like, and hope investors don't go deep into the areas of our house we really haven't done sufficient work on. And that puts all the work on the buyers to inspect and demand what they want fixed first. As the seller, you hope they don't find stuff that's going to cost you a lot to fix. What's happening in investors' minds? As buyers, we hope we don't miss stuff that's going to cost us our whole investment. And this sets up a relationship that is more adversarial. If a transaction does get completed, it's either going to take a lot longer for professional investors because you're expecting them to do all the inspection work to prove your business model for you, or you got to win a lottery of attracting some gambling investors to fund you anyway, instead of gaining the professionals that can really help you. Now, by the way, that is like a lottery. You need to keep buying a lot of tickets to get in front of investors and keep hearing no and hope you find a sucker before you run out of money if all you want is the money. Speaking for myself, I'm a professional angel investor, and I have no interest in founders that want to pitch to me a collection of unquantified gambles. I won't invest on the strength of the pitch deck where I only get to see the good stuff. Now look, in this business, everything is a gamble, but it might be more correct to say that I'm looking for a set of informed and supportively quantified guesses, not misinformed and uninformed guesses about what commercializing your solution and delivering me an ROI looks like. Quality due diligence isn't what I do. It's what you do first. It is the case that founders make first to themselves, that they have planned and sufficiently planned to be as successful as they wish for us investors to believe in. And I admit there are competing messages out there. It's easy for folks who are already billionaires to say a lot of half-true stuff. What if you don't need any more proof for yourself? Isn't your self-confidence good enough to solve any problem and overcome roadblocks as they appear? Why should you need to go looking for problems to fix that you haven't faced yet? See my passion, my intelligence, and my drive. Look at my team. Investors, why can't you just believe in me? Well, it's because we're not making a donation to your technical achievements or your hopes and dreams. We're investors in companies. This is a business value proposition. Always was and will be. We shouldn't be investing in ideas, but in business plans that are likely to be executable. Ideas are only imagined future states. Plans are quantifiably deliverable future states. Now, this sentiment isn't new, that all we are investors who care about money and we're soulless. People who love or hoard money aren't angel investors, believe me. Angel investors are in their physically declining years, weathered enough to have learned that money is only a tool and a measuring rod producing value for people. If you can't provide value that others are willing to pay for, then your world-saving, or at least industry-saving ideas will never be widely applied to accomplish the good you actually want to accomplish. The dollar is its own beast that will not be disrespected in this. You need to understand that. If you can't make the dollars work, then investing in you only keeps those dollars from being deployed where they can actually do the good of helping a worthy business idea succeed. So let's have a virtual Q&A. So here's you. Before it's time for due diligence, before I even pitch, I must plan? For heaven's sake, yes. You must plan in exhaustive detail whether you ever need outside investment or not. Remember, you are your own first and principal investor. Don't you want to know how you can succeed so you can increase your own confidence in your future? And here's why planning is the only way. When you do the bottom-up projections that require you to build an equation representing a set of logical assumptions behind every number in your projection, you discover game-ending risks hiding like lions in a forest waiting to pounce on you. It forces you to change your plans and overcome those risks before showing it to us investors. And then after you pitch, professional investors need only to confirm your planning work and lend insight into how to outperform even your own expectations. But if you don't do your part first, professional investors with experience will find your risks, start questioning you about them, and you won't have supported answers and won't gain investment. Okay. So if I do all that and then pitch and investors are interested, how do I prepare for due diligence? Well, this is the beauty of first having done the diligence for yourself and not for us. If it suddenly becomes a heavy lift for you to do research and prepare material just to answer my questions when you receive them, then you were unprepared to succeed prior to pitching to me. The only preparation you should need to do for due diligence with me is schedule more meeting time and forward information to me that you already have. If you need to create a bunch of fresh new material because I'm asking for it, then that's like teaching to the test or planning to the investor's checkbook, rather than planning to succeed regardless of how the company gets financed. All right. Then if I did this right, how long does due diligence with investors take? Well, investors should not be in the role of educator. And thank God you have Anita and Eric and UACI. But we investors often meet founders we need to educate first, and slows down the process and reduces investment. You should want your investors' efforts after investment to help you solve hard problems unique to your business and the marketplace at that time, not help from us with common challenges that all startups face, like how to develop a go-to-market strategy or build a staff or plan for cash needs. You should have done all of that first. So if you're ready for us, the process should take about 30 days. If you're not ready for us, it can drag out for months to become investable. And if you're already short on cash before you start fundraising, well, then you're not ready, and that's probably lights out for you. Okay, fine, dang it. If I buy into this business planning business, then what's included? All right, then. Well, here's what you signed up for when you decided to start a company. You might not have thought you were signing up for this, but you were, or else doomed to fail. So here we go. You need to have all of your company formational documents, contracts, and agreements of every kind. Board meeting history, your policies, all of it well organized and available at all times for instant inspection. It's time to behave like a business, not a hobby. You need to have charts and process flow illustrations that show how you go from raw inputs to finished solution, and how you go from dollars in to dollars spent to customer dollars in return. Trust me, some of you have this in your head and think it makes sense, but as soon as you try to commit it to paper, you find problems you didn't know were there. You should have an evolving and living timeline that lays out all of the key milestones, dates that you've achieved not only in the past, but for the future life of your company, from birth all the way through multiple exit windows. You should have a solution roadmap with past and planned dates for future major new solution releases, enhancements, or version releases. You should have a way for every potential investor to help us experience, as potential investors to experience the problem and your solution, not just a verbose description. We need demos, samples, live environment experiences, befores and afters, anything you can do to help us relate to why your solution is important. You can't just assume that you can explain it to us in 5 minutes and we'll get it. And when it comes to this one, market research, you have weeks of work to do here, not an afternoon of DuckDuck Google searches. You may need to hire professionals as well. You need to be able to not only predict, but deeply speak to all of these sorts of things. That's a big list. You've got to go into detail in understanding where you're positioned, how your price compares to your competitors, what your reimbursement model is and how it works. all of those measures like TAM, SAM, market share, and compound annual growth. You've got to even look at indirect competitive pressures and parallel potential entrants that could notice your success, but are much bigger companies with deeper pockets that could come in and compete with you. And you have to tell us about it. Now, all of this needs to become quantified and used in bottom-up equations that support your sales projections. And without this depth of research, your sales projections are BS, and we know it. How are you going to break in, find early adopters, gain traction, burst through the early adopter burn-off that I call the wall of death, and then scale to the front of the pack? And that includes a lot of its own details. What is your channel strategy? Who are you going to sell through? How are you going to share revenue with people that help you get to the customer? What is the sales cycle in length? How many labor hours does that require? What about delivery and support cycles? What about sales KPIs? CAC, LTV, repeat, churn? Do you have comparables that comparable business types that you have trajectory information on to see at what rate they grew and what their sales achievements were to keep you and your assumptions realistic? Once again, these are not a collection of mini essays. I don't want this in paragraph form from you. I want quantified plans, numerical, used in bottom-up equations that support sales and operational expense projections. Without these elements known, your sales projections are still BS, and we know it. And then there's your intellectual property. This describes organized documentation of all formally awarded global IP protection from application to award, as well as policy descriptions of trade secrets and private work product, handling procedures to ensure it doesn't fall into the wrong hands. Documented, available instantly on demand. Every member of your team today that includes executives, board members, or advisors should be able to impress us with deep and clean background checks, from legal to credit history to social media habits. Have detailed personal histories and profiles on everyone ready to share and reveal anything unsavory up front. By the way, teams filled with family members or part-timers invites extra scrutiny. Be prepared for that. So what is your org chart today? What do you expect the org chart to look like at exit? What is your role-by-role hiring plan from today until exit? Do you have pre-written role descriptions and compensation plans? Did you include the costs of HR management and administration while scaling? Do you know what your labor force will cost from recruit and hire all the way to termination? Is this all in sub-tables feeding your labor costs in your main projection tables? Remember, everything needs to be quantified. If you're in manufacturing or handle physical goods in any way, who's producing today? Where? At what cost? What about tomorrow? Do you have backup? What does cyclical economic downturn do, or supply chain disruption? Another pandemic? Natural disaster? Risk of regional war? Drought? Famine? Criminal activity? How many ways might you fail to produce to deliver on time? And what are your mitigation plans to first prevent or ultimately pivot if you experience a black swan event? All this quantified planning needs to feed into a three-dimensional financial model of the past and future. It's an evolving tool, continuously being updated and adjusted so that you can change any one input variable and it will change the entire model. It'll recalculate it. And why? Because it will show a running cash at end of month for years out, around which you can then construct a birth to exit company capital plan and know how much money is needed at various points well before running out of cash. It's the only way you can backbuild fundraising timelines with pre-identified targets of who you're going to approach to raise money from, and do it in time. We're not done yet. How do I, as an investor, get my money back? How do you get rewarded? When? What are the various, meaning more than one, exit inflection points? What are the triggers that let you know when each point is reached? What are your theories of enterprise value at each of those potential exit points? And finally, what are the terms of the deal today? If you're going to raise a round, do you have a term sheet ready, or at least a template with all of the terms and an offering starting point so that you can negotiate with a lead investor? Do you know what all those various terms mean so that you're prepared to negotiate? And do you have a theory of enterprise value today that you can support logically and quantifiably, not wishfully? I already told you that when you started a company, the solution idea became merely your vehicle. Your status as an inventor or founder is secondary. Your first mission has become that of an executive, guiding a financial mission to a conclusion. If you don't want to run a company, then don't. License your idea to somebody who does. All right. I did the work for real. I'm ready. What happens next? Well, from application to signing, investors are going to ask you a lot of questions, electronically and in person. If you got the point today, then you'll plan to already have answers ready to go. You not only have to have them documented, you and your team need to know them well. And I'll share a secret. Investors compare notes across the country, and you don't know it. Just happened this week. There was a company that applied to Desert Angels led by an investing group out of Florida. I personally happen to know one of the folks at the Florida group. I called them and I asked them for the scoop. If different investors ask you similar questions and you give us different answers because you're making it up as you go, we'll know. So what are investors going to do with my information? Well, what we're going to do with it is form an investment thesis. We'll challenge your information against our own knowledge and experience and try to answer that question. We're going to read everything you gave us and seek third-party independent verification of your assumptions that can include people you already know, like your customers, vendors, employees, maybe competitors, as well as some people you don't, because within our own networks, we may know industry leaders in your sector, and we're going to be looking for objective validation. That's why the less well-planned you are, the more information we've got to go develop on our own, and the longer it takes, or more likely, you're just going to get turned down early because we haven't got the time and interest to do the work that you should have done already. So final question. 2 questions. What does Desert Angels consider an ideal investment, and how important is due diligence to the Desert Angels? Well, the answer to the second question is duh. The answer to the first question is really anything that meets the needs of enough customers that they're willing to pay a premium for. We're generally industry and solution agnostic, but our investors in our group make individual investing decisions. We don't decide as a group. So individual investing preferences do exist. Can't really characterize them group-wide for a group like Desert Angels. But that said, there are other angel groups out there that are sector or theme specific. Still, the quicker, easier, and more completely you can provide diligence material to any of us, the more likely you are to succeed with us.